That's closing bell on Wall Street, and now it's market domination overtime. We're awaiting Apple and Amazon quarterly results, and we're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Jeff McClain, Solidarity Capital CEO, and markets and data editor Jared Blikre joining us to break down the moves today. Jared, my friend, let's start with you on that close.
All right, I was looking at a mixed market until the NASDAQ dipped into the red, so now it is a red day overall. The Dow down 330 points, about 0.75%, and I'll show you the intraday just quickly, closing pretty close to the lows of the day. Here's the NASDAQ composite just dipping into the red by the close, and the S&P 500 down about 1/3%. Also, the small caps down even more, 1.17% for the S&P 600, and I want to skip over to the dollar recently just to show you it's up again. That was 6 days straight, so I find those streaks interesting, especially given the bearish positioning and sentiment. But we've got to move on here. Only two sectors in the red. One of them had a record high today. That would be utilities. The other leading the way was communication services, up 0.9%. That is a meta story. We'll get to that in a second. Healthcare looking pretty dire after some bad headlines from President Trump there, down 2.77%. Real estate, materials also down more than 1%. And we move on to the NASDAQ, where Microsoft posting gains of 4%, Meta up 11%, Tesla down 4%, more red than green on this board. Let me just show you the market cap, just so we see where Microsoft closed. 3.965, and so that was it was over 4 trillion on the open, and just couldn't hold on to that into the close there. But let's take a look at semiconductors really quickly. We got ARM earnings after the bell yesterday, and that has led to some pretty big losses in the complex here. A few in the green. Western Digital up 10%, Mobileye up 2%, but semiconductors taking it on the chin today. And I will show you the pharma sector as well, so we can see how those headlines regarding drug pricing have hit some of these drug makers. AstraZeneca down 4.5%, Novo down 6%, Merck 4%, Sanofi 7%, and the list goes on. I will close here with a look at the Dow, and we can see aside from the mega caps that I already covered, a lot more red than green. Walmart up 0.4%, Caterpillar up almost 1%, and 3M up 1.77%. But aside from that, we're going to say most of that board was red outside of those names. Back to you.
All right, thank you, Jared. Jeff, your thoughts on today's trade?
Yeah, I think overall, from a market perspective, with the sheer amount of trade deals that happened today around tariffs, to have the market be essentially flat is actually a really good sign from not an overreaction to the amount of tariffs being hit here. Obviously, Meta is the story today of a company of that size, nearly up 12% is shocking. I will note too, because we're waiting on Amazon earnings here, Amazon up nearly 2% today ahead of the earnings. Interesting by investors excited about what we're about to hear.
When you look at these big tech results, Jeff, and the kind of response to results, Microsoft jumps hard. Meta, it was up 12% last time I checked. Do you look at those big tech results? I've had folks kind of make the argument on the show, maybe you just need to follow big tech. And if they look solid, right, if they keep being rock stars, then you stay long the market. Is that too simplistic in your opinion?
Not necessarily if you're already in. The hard part is if you're not in, right? From a buy perspective, like would I recommend someone buy NVIDIA right now? No, I mean
because the move off the April low has been too hard.
Yeah, it's so expensive from that perspective. But you look at some others in the tech space where, again, you see what Meta's doing. Google's a pretty interesting valuation right now, way below everyone else, and so there's opportunities out there. If you're in them, holding's a great strategy.
When you look at the market right now, Jeff, sometimes you get a little nervous when no one really seems nervous. What is on your radar of worry?
Yeah, I think we're enjoying the summer. I think everyone is excited about where we were in April and where we are today. I expect volatility, though, as we enter here into August, September. Historically, September in particular, a bad month for the market as traders come back from the Hamptons. I think you're going to see some volatility here in August, September that gives investors an opportunity to take advantage of opportunistic buying.
All right, let's switch gears here because it's time now for a look at Amazon. Its second quarter results hit the wire. Let's get to Yahoo Finance. Josh Schaefer with the latest. Josh.
Hey Josh, yeah, Amazon stock been trading on both sides of the flat line after this report came out. So I'm going to give you the high level numbers here. Amazon reporting revenue of $167.7 billion. That was against a street estimate of $162.1 billion. So a beat on revenue there, also a beat on earnings per share. Amazon posting adjusted earnings per share of $1.68 against a street estimate of $1.32. I do want to read some other key metrics for you here, Josh. So the second quarter operating income, that came in better than expected. Amazon posting second quarter operating income of $19.17 billion, above an estimate of $17 billion. But key metric here that I think has maybe perhaps held the stock back, reading through the report, I would have thought maybe up. You take a look at the third quarter operating income guidance, pretty wide range from Amazon here. Amazon with a range of $15.5 billion to $20.5 billion for operating income. Of course, that's perhaps where maybe tariffs could come into play, right? The street was looking for an operating income in the third quarter of 19.42. So Amazon with a wide range. The low end range of that third quarter operating income is lower than what Wall Street had hoped for.
And Jeff, I want to bring you here as well because I think you hold this one. Another metric is AWS sales, of course. That's what folks are going to make a beeline for. It looks like AWS net sales ex-FX plus 17%. That is smack in line with estimates.
Wow. Okay. No, yeah, AWS is where my attention goes to all this. That's the growth engine for where Amazon's going to go. They obviously, I'm assuming we'll find out in the actual text, but with that wide range, I'm assuming they're building in some tariff concerns, especially around there on the low end.
They have also, I remember, Jeff, too, and it'll be interesting how they comment. I remember they've also talked about in the past being, on AWS specifically, being capacity constrained, and I wonder if that's another issue that'll be brought up.
Well, that's an issue with all AI, right, of capacity from a power perspective and just getting the products here to continue to build and grow it. I expect AWS to continue to be the growth engine. They have some headwinds there, obviously, like we've touched on a little bit, but that's a great number for me. And I definitely want to dig into that forward-looking guidance of what they're worried about.
I also wonder, to the extent that, obviously, now this is the last of the cloud giants to report. We had Google, we had Microsoft, and that Azure print, which really impressed people. I think it was 39% maybe. And I wonder, I wonder if that was set some type of bar for them as well, AWS. Yeah,
it's tough if you're not the best-looking girl at the dance. And that's where kind of Amazon might be coming in here, right? Next to Microsoft, it looks bad. In a vacuum of totality with Amazon, though, it's a good number, but compared to Microsoft, I can see why the street might react negatively.
What do you think, Josh?
Yeah, well, I think when you think about that Microsoft Azure number, I mean, we were talking about this on the morning show this morning, to surprise Wall Street by over 4%, like Microsoft did yesterday, they hadn't done that in over 2 years, right, for that Azure growth. So to see acceleration in that part of the business is a huge story for Microsoft, and it just sets perhaps a high bar for Amazon. And you also brought this up earlier, Jeff. I mean, the stock was already up 2% today, too, right? Yeah. So we're looking at a stock that's essentially trading almost flat over the last 24. Like, it hasn't moved a lot, and it's certainly not selling off. I think this is a company where you definitely want to hear more on the call, especially when it relates to AI and what is AI doing for AWS, right? That was a story Microsoft told very well last night on the call.
And we have a very smart analyst, fortunately for us, to come up, break down these numbers. Stock down about 2.5% right now. Our next guest, Sebastian Page, head of Global Multi-Asset and Chief Investment Officer at T. Rowe Price. Sebastian, big week for tech earnings. I want to know, if your current strategies, do they kind of align with what we're seeing here, Sebastian? Are you pounding the table on big tech?
We're neutral between growth and value stocks. We like big tech stocks for the long run. Listening to all these earnings results and seeing some stocks not react that much, I kind of wonder philosophically, if everyone expects a positive surprise, is it still a surprise? We have the tyranny of high expectations here. Josh, I had a mentor once told me, reality, happiness equals reality minus expectations. We had 13% year-over-year growth in Q1 in earnings, and we're beating 80% on sales so far. The long-run average is 64%. Those are good earnings. Let's forget about all the gloom and doom about tariffs and the Fed. They matter, but these are strong earnings and they're sustaining markets.
Let me ask you, Sebastian, I've been talking to you for a while now on the show, and when you come on, it's been, and correct me if I'm mischaracterizing, but it's been sort of there's tailwinds, you argue, but there's headwinds, and so you've been sort of neutral risk assets. And yet we see this melt up in the stock market. What do you make of that, Sebastian?
Here's the trade-off right now. The fundamentals are good, and they're better than you might think if you focus day to day on the financial media. You have growth expectations that are inflecting back up. You have fiscal spending coming in. As we just said, you have strong earnings. You have AI spending. It's expected to grow by 80% globally year over year. So you had the DeepSeek moment, and the big tech companies just said, hold my beer. We're going all in into AI. So the fundamentals are good. The fundamentals are good from a macro perspective. And what worries me, what worries our asset allocation committee is those valuation levels. It's kind of this agreement.
We're looking stretched.
We're looking stretched. 22 price earnings ratio is often quoted. It's not a really good short-term indicator. But then you have Goldman Sachs speculative trading index, all-time high. You have high risk, high beta, low quality stocks outperforming high quality stocks last quarter, pretty much by as most as they've ever done since 1991. So you're starting to see speculation. The meme stocks are back. Crypto's rallying. Now, I don't want to sound like I'm calling for a bubble, but I'm going to say in our asset allocation committee, we're starting to use the B word and discuss, are we in the run-up to a valuation bubble? Stocks are up 30% in 3.5 months.
Yeah.
So that's the trade-off, Josh. Fundamentals is probably better than the narratives around tariffs and the Fed being too restrictive. Financial conditions are loose, but the valuations are way up there right now.
Jeff, I want to bring you, Sebastian brings up a very interesting theme that I would like to get your take on, which is the fact that all of a sudden on this show, I am talking a lot about meme stocks. Yeah. I'm talking about SPACs again. I look at the reception some of these IPOs are getting. I mean, is it fun, concerning? Is it a sign of froth? What do you make of it?
Yeah, I mean, look, you're a kid in your mom's basement, the meme stocks is super fun. But from those who take a more fiduciary approach to it, it does make you nervous. I agree completely that there is a need for some volatility. We think some is coming. I think we've had a pretty smooth ride up and to the right since April lows. Now is the time here, I think over the next 6 to 8 weeks, we're gonna have some choppiness in the market, which means there's opportunities to be had when there's choppiness. But I think something has to give there when you're seeing all the meme stocks, crypto, all the leverage ETFs, everything's booming right now. There has to be some rationality to the market. And the frustrating part, I think, specifically for Chairman Powell has got to be the average person is kind of struggling out there, but you have a stock market just shooting to the moon. And so how do you balance those two things when you have the average American still kind of hurting, but the stock market and those investors in it at all-time highs?
That's a very good point. Sebastian, where do you see the opportunity right now? Do I want to stay in the U.S.? Do I want to go overseas? What would you see internationally?
In our asset allocation committee, we're neutral on risk. We're long diversification, including long international value and small and mid caps. And we're short duration, short long treasuries, positioned for potential upside surprises in inflation. That's the broad positioning. We like international value stocks, for example. Josh, I had an analyst send me a valuation dashboard between non-US and US stocks, and I thought the numbers were all wrong because the return on equity was 5% higher for international, the earnings growth was 2% higher, and the cash flows were solid, and I thought, this is wrong. I was ready to yell at the analyst. I don't yell at analysts, but that time, it wasn't wrong. It was a different lens. It was looking at the median stock, not market cap weighted data. This means that there's a broad set of stocks outside the US in the small, mid, value universes that have better fundamentals than their counterparts in the US that trade at 3, 4, 5 points lower in valuation. So we like that. The trade has worked here to date. It hasn't worked for the last 10 years. But now you have momentum behind it, and counterintuitively, all these tariffs, they're kind of forcing Europe in particular to become more self-sufficient, to invest in defense, to invest in spending. Our analysts expect the debt to GDP ratio in Germany to increase by 20% over the next 10 years. So you have some momentum here.
Sebastian, Jeff, great to have both you guys on set. Thank you, appreciate it. Thanks. And coming up, we dig deeper into Amazon's numbers with the help of a Wall Street analyst. Stay tuned for that. Amazon reporting a beat on earnings and revenue for the second quarter, while its key Amazon Web Services segment saw sales increase 17.5% year over year. Here with a closer look is Wedbush Securities Managing Director of Equity Research, Scott Devitt. Scott, great to see you, sir, as always. So Amazon reports, Scott, the just at least initial reaction in the after hours, Scott, we got the stock down about 4%. What do you make of the results?
They're good. I mean, I give it a B plus. I'll tell you what's good and then why the stock's probably down. The retail business overperformed healthily. Advertising was very strong. Operating margin beat by 13%. And then AWS, 17.5% growth is healthy, but because of the overperformance of Google's cloud business and then Azure, whispers were kind of creeping up towards 18, 19. So it's not a miss relative to analyst expectations, but relative to buy-side expectations, going into number, maybe that was a little bit light. And I think that's why you're seeing the response in the stock.
So you think it's a compare and contrast story right now, Scott? The bar got set high by Microsoft, by Alphabet?
Yeah, it's like being the cleanup hitter and having the first three batters hit home runs in front of you. The bar's rising, and then you have to do something even better. And in the case of Amazon, it was a good AWS quarter. But if all you're going to focus on is AWS, and you look at the prior reporters, most notably Microsoft and Google, their results for the 3-month period were better, relative to expectations. And so there's nothing wrong here, but it's just an expectations, miss in that regard for a stock that has been relatively strong in recent weeks.
Can I ask you, in that big cloud fight, Scott, now that you've heard from all three, Microsoft, Alphabet, Amazon, what are Amazon's competitive advantages there?
So like Azure has, a lot of affiliation with OpenAI ChatGPT, which helps the revenue of the business. Amazon's tied to Anthropic, which is smaller but starting to grow and will be a more significant contributor in the second half. I think the moat that Amazon has, which is the question that you had, is that they are the legacy leader in providing the services. So as they layer AI into their product portfolio, as they've done, their customer base gravitates towards that and they continue to grow. But it's a battle. There's three very good companies, going after this cloud revenue. And Amazon had it kind of all to itself for many years. And now, Azure looks like the prettier girl at the prom, if you will, at the moment.
Let me ask you, Scott, about this other metric here. They did project operating income in the current quarter. I don't know if it fell short of your estimates. It does look like it did fell short of consensus. Operating profit's going to be between 15.5 to 20.5 billion. It looks like in the period ending in September. I'm just curious what you make of that data point, that metric, Scott. Is that perhaps worrying folks? Well, maybe they're turning on that spending spigot just a little too hard.
It shouldn't. I mean, the CapEx year to date is 57 billion, and so they're probably going to ultimately do more than the 105 billion for the year. But the reason why that guide is not an issue is that Amazon's been exceeding the high end of their guidance for many consecutive quarters. In fact, it guided to the second quarter of, I think it was 13 billion to 17.5 billion and just did 19.2. So when you look at that guide in respect to what it just did relative to its prior guide, you conclude that estimates are just fine. It's just the way that Amazon guides. They put a low hurdle out there to beat. So if that's driving, some of the underperformance after hours, that's a non-issue. Where I think the core focus is, to the extent that you're matching, stock price performance to where actually there was disappointment, it had to be in that AWS number.
And when you model out the AWS growth and margins from here, Scott, what does it look like?
I mean, this is a business that go 15% plus for many years. I mean, Andy Jassy has talked about the fact that only 15% of workloads, are in the cloud still. So while it's a very big business, if you take their quarter and annualize, it's a $120 billion run rate business. That's significant. There's still a long way to go just in terms of taking in-house IT and turning it over to the cloud. And then when you overlay AI on top of that, that's tens of billions of dollars of revenue opportunity. So this is still a very strong long-term growth story with low to mid 30% margin and a big contributor to Amazon's value, in the future from here. The thing with Amazon, as a stock now, because they're in like three somewhat distinct businesses in retail, advertising, AWS, and when they report in the earnings season, when others report in front of them and expectations get set, they kind of have to hit the trifecta. And they were like 2 for 3, today. And it would have been better had the company exceeded the AWS number because that's where more of the incremental value is perceived.
How Scott, should we as investors think about potential tariff implications for Amazon?
So that's manageable. I mean, the merchants, to the extent that there are implications, merchants will eat some. Amazon will take on more 1P inventory and be more competitive in price. The tariffs have proven to be less aggressive than initially thought. And so there are workarounds in ways that, you almost don't see it in Amazon's results as you haven't seen it yet in the second quarter operating profit, and with the way that a company guide, and I don't think it's really going to be relevant unless this changes again. But the way tariffs are looking right now, I think it's more of a non-event.
We talked retail, we talked cloud. What about that advertising segment, Scott? I'm curious what you see ahead.
Oh, it's amazing. I mean, it's a $60 billion business now, doing probably close to a 60% operating margin. So they're in third place, but a very strong, third place behind Alphabet's business and Meta's business. And that's also a line item that's very high margin that should be able to grow 15% to 20% for some time, because you have the layering on top of the retail business, which they benefited from for some years now. But you also have the opening up of the video platform and off-platform opportunities that advertisers can now attract with Amazon. So that's a 15 to 20% grower for many years ahead, outside of years when we have recessions.
Scott, always great to see you, my friend. Thank you. Appreciate it.
Thanks, Josh. Appreciate it.
Time now for what to watch Friday, August 1st. We're going to start off on the trade landscape. President Trump's self-imposed trade deal deadline. It's coming up on Friday. New standard of 15% tariffs on foreign goods is taking shape, including recent deals with the EU and South Korea. Also, Trump on Thursday extending Mexico's 25% tariffs for 90 days as trade negotiations continue. And turning to the labor force, the monthly jobs report for July is coming out on Friday. Economists forecasting non-farm payrolls to dip to 104,000, while unemployment and hourly wages both tick up to 4.2 and 0.3% respectively. The new data coming after the Fed held interest rates steady for July on Wednesday. Powell saying at the post-decision press conference that unemployment remains low and that the labor market is still solid. On the earnings front, we'll be getting another batch of earnings on Friday that include names in the energy sector like Exxon, Chevron, and Enbridge. Exxon announcing results for the second quarter. Analysts expecting Exxon's oil production business to be weighed down in the second quarter by lower oil prices. Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Ask for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.